Hello all. So in this session, I'm going to explain about the importance of having higher initial capital when it comes to the process of investing and wealth creation. So high initial capital, it's in the process of compounding, that is multiplying your money, multiplying your initial capital in the process of investing. The magic of compounding works wonderfully well if the initial capital is slightly higher. I'm not saying that one needs to start with $100,000 or $1 million to have that snowball effect and to accumulate and make the capital appreciation faster. But it always helps to achieve significant a higher capital appreciation, faster way to the financial freedom, and faster wealth accumulation if you have slightly higher initial capital in the range of 20k, 30k, and maybe 50k on a nominal rate would be pretty good if it is in that range for the high initial capital. And in this video, I'm going to put a hypothetical scenario where I'm giving an example of the how I'm going to vindicate my point of why it's important to have that high initial capital, how it helps. And I'm also giving a couple of ways to achieve that high initial capital, and couple of ways how to save that high initial capital. And let us get into that scenario. So here's a hypothetical scenario, and where you have two people, Maria and Ron, who are starting to investing in markets in simple index fund, not even stocks, at the age of 25 years. Both are starting at the same time, and Maria is starting with a initial capital of $65,000, whereas Ron is starting with just $100. Now, in this scenario, Ron is going to put $1,000 every month from his income, from his savings, into the index funds, and whereas Maria is going to invest only half of that amount, that is just $500, for a period of 20 years, and we will consider two stipulated periods, for a period of 20 years and another stipulated period of 30 years, and we'll compare how the return ratios, return profiles looks like at the end of this stipulated period. Now, here is a table that shows where Maria is putting initial capital of 65k and Ron is starting with just 100k, like any of us. And every month, for the next 20 years and 30 years, correspondingly, Maria is going to put $500, whereas Ron is going to put $1,000. That is double the amount for a long period of 20 years, 2 decades or 3 decades. That's a significant differentiation because they're going to have put half of that amount. Maria is going to put just half of that amount. Now the total capital put by her, Maria, in this 20 years is total of 245k. That is, she puts a 65k initially, and over a period of 30 years, and for 12 months you multiply, for over a period of 30 years she is going to put total of 245k. Now Ron is going to put initially with 100k, $100, and he is going to put $1,000 every month for 30 years, so 30 times 12, and every month, and $1,000, so that brings it to 360k approximately, right? So look here, there is 100k that Maria is putting less over this 30-year period. That's a huge difference. Now you are going to compound, you're going to annually compounded annual growth rate. If you take it for, say, 10% compounded growth rate, CAGR you call it, that's because you're putting an index fund. Index funds usually return anywhere between 9 to 10% with dividends. So you are going to get, you at the end of 20 years, when they are 45 years old, and Maria is going to end up with 856k because of that compounding of 10% on the capital that she is putting in, including the initial capital. She's going to end up with 856k, whereas Ron is going to end up 100k less. So he is going to have 760k. Now look at the difference. Maria is putting 100k less overall in that 30-year period, and Ron is going to end up putting 100k extra. But even in 20 years time frame, Ron is going to be ending up with 100k lesser returns. And if you take a 30-year period, the gap is reduced, but still it's significant, right? Where Maria is going to end up with $2.42 million. That's much higher than Ron's total $2.26 million. So that, even in spite of considering 30 years of putting $1,000 extra every month, double the money of what Maria is going to put, Ron is going to end up lesser than Maria. So that is a significance of having that higher initial capital. Now, as the initial capital goes on less on value, say Maria is suppose starting with 30k, Ron might end up having more than Maria during this course. So the more initial capital you're putting in the market, the more your returns are going to be. So this is, just replicating, or in symbiotic to that famous saying that time in the market is more important, more powerful than timing the market. And that's why, there's such a stark difference when in the return profiles when you look back, over a long period of time. Now, this might not be realized immediately, and that is a bias, that is a tendency, human tendency of, the short-sightedness that comes in when we don't take a long-term view. That's the importance of taking a long-term view. In the near term, that money does not look, the difference will not look huge, and people will think that they can considerably put every month on month and increase the savings. But trust me, having the higher base helps, more time in the market, that helps. Now, here are two steps to increase that initial capital. These are two most important decisions, I would say, in terms of purchasing that we do any human beings. One of a couple of most important things, I would say. One is the buying a house. That's one of the most important decisions we all take in our day, in our life. The second most important decisions may not be once but multiple times, is buying new cars, right? Buying cars. So these are the two easiest way, one can achieve or save that initial capital. And how is that possible? It is simple. So one low hanging fruit is, obviously the cars. So purchasing old cars, or used cars rather, is a better option than purchasing a brand new cars, because a new car is a highly depreciating asset. Cars are generally highly depreciating assets, with a complete markdown of 30 percentage, a markdown of 30 percentage as soon as the rubber hits the road. As soon as you take the car out of the showroom, it's 30 percentage value depreciation straight away. And that's the reason why, I emphasize on purchasing used cars, a slightly dated one. Whereas, it could help to achieve that. Normally a car would end up, purchasing a new car for an average person would end up being 30-35k, whereas a used car might be ending up 10 to 15k. So there's a 20k save straight away there, into the initial capital base that you want to build. So this is one area one can focus. And it need not be that you always end up buying a used car. Eventually, when you achieve that kind of a scale, like a base of, you achieve the financial freedom, and you have a base of, you could afford a base of 5 million, $10 million, you can definitely consider buying a new car at that time. That's just delaying the gratification. Now, the other area one can look at reducing is the down payment that you put towards purchasing a house. Purchasing a house, there are many, deliberations that are happening in the markets, whether it's a wise idea to purchase a house or than staying or renting it out. I'm not getting into that kind of a debate here, but what I'm trying to say is, even if you're purchasing, don't look at building the equity, putting a large sum of capital towards the down payment that you make that as low as possible. The down payment can be as low as possible, like 3%. If 0% is great, maybe 1%, 3%, whatever that amount that you're putting from your pocket. Remaining, get the mortgage, because the interest rates are way too low in today's generation, in today's market conditions, and you are not shelling out too much of the interest rate. And so putting a high equity doesn't make sense at all. Put that money to work in stocks or indices, where you're getting a returns of 10 percentage, but you're shelling out only 2 to 3 percentage for your mortgage. So your return should be made higher by investing in wise assets, like indices over long periods of time. That makes a significant difference. Compounding at 10 percentage, we saw in the previous example how much difference does that make. And it's almost a couple of 100Ks if you are having higher capital, initial capital. And now, if you are considering 65K, that was a difference. But if you're putting a $1.5 million in the initial capital, the difference even going to be much bigger. So timing the market, again reiterating, is much important than timing the market. And also choose your return ratios accordingly. A return on the indices, even the dumbest indices, I would say, although nobody can, there is no brain behind it, it's just a group of largest share equities. They are returning 9-10 percentage, and if you wisely pick stocks, the returns could be even higher. You can achieve 18-20 percentage. So that's the reason you should not put higher equity towards mortgage. So these are two areas where you can easily achieve that, shave off that higher initial capital and channelize that initial capital towards higher generating, return generating assets like equities. And I hope this was helpful to understand this concept. And consider always putting money, saving that money towards that initial capital, so that you can end up being financially free faster in life. Hope this was helpful. Thank you.